All right, everybody, I want to welcome all of you to a monthly edition of our Trader User Group. This is just a market recap for the month and just kind of what we look at coming through the end of the year, I guess. But before I get into anything, let me just read some common disclosures, which most of you are probably all familiar with by now. Trading securities is kind of high risk, and the loss of any potential funds invested. Any investment information provided by our user group may not be appropriate for all investors, provided without respect to individual investor financial sophistication, situation, time horizon, or risk tolerance. Therefore, any information, techniques that we talk about by our user group is intended to be for educational purposes only. It's not intended to be a recommendation to buy or sell any specific security, no matter what your rat brain is going to want you to do. Okay. Now, having gotten the particulars out of the way, what I thought we would do is what we always do. I know there's a lot of folks on this morning that are attending free. I've decided to do our monthly sessions for free to just kind of broaden the audience a lot. We've got a lot of members on, but a lot of free folks as well. One of the nice things about these monthly meetings is I used to do them on site, more like an on-site seminar, but I have a lot of folks that we've grown dramatically over the past 5 or 6 years, and a lot of folks have asked, can you just incorporate that into a monthly and do it online? So that's what I'm doing. This is my first attempt at doing this. Now, for all of you that are viewing this for the first time or our members, this recording is going to be out into our blog. That's where it's going to be. So you'll be able to access it from that perspective. Okay, so that's where it'll be. It'll be recorded. I got a ton of email from folks that can't make it but would like to see it later, so it'll be out there. It'll also be posted in YouTube and other places too, wherever our Mad Hat technology geniuses decide to post it. Okay, why don't we just jump into the markets as we always do. I am going to start off with going around. Before we jump into the specific charts, I'm going to kind of go around and just talk about Asia, the European area, and then the Americas, and then we'll jump into the charts. As always, if any of you have any questions, just type them in the question box. If you have any specific securities you want me to go over, just put it in the question box, and I will get to it, okay, I promise. Or at least I think I promise. So starting with the Asia Pacific area, China delivered a surprise this past Friday. I think they're ready to deliver even more deeper interest rates cuts after this past Friday's unexpected decision to reduce their borrowing costs. Now, this is the first time they've done this since 2012, okay? And they're the world's largest economy, and they're on track this year to have the weakest annual growth since 1990. Okay, that's quite some time. And it looks like the PBOC, which is the People's Bank of China, is going to act to shore up demand there. So, when they came out with that announcement on Friday, the reaction in all markets globally was immediate. And, if you were looking at the screen, if you walked away and then you came back, or depending on what time zone you were in, when you woke up in the morning, you saw a big bump and just wondered what the heck went on. But most global stocks, including oil, energy, metal prices, everything just kind of rose on China's movement. But we didn't really stop there. We'll talk about what Europe did as well in the ECB comments coming out of Draghi. But over in the Asia Pacific area, China, looks like they're going to undershoot their official growth target this year of about 7.5%. They've got slowing inflation. They've got elevated funding costs. They've got issues with some of their banks. And this basically signals a pretty big policy shift from the PBOC, the People's Bank of China, to be more aggressive in monetary easing. But what else is new, guys? I mean, we've seen monetary easing in every major economy globally, going back to 2008, 2009. Some were pretty much slow to the uptake, like the ECB or Japan, but they've come on. And China, it looks like their slowdown is going to deepen. So that kind of jeopardizes, as I said, the government's growth goal. And to kind of compound the misery over there in China, factory production rose 7.7%. Now I say only. For China, that's low. That's the second weakest pace of factory growth in China since 2009. Okay. They also had a very low increase in fixed asset investment for machinery, the lowest since 2001. So this all signals lowering inflation in China, more stimulus, and again, like I said, this stimulus, this is the first time that PBOC is doing it since 2012. You know, it just shows that the government's a little bit concerned things are just slowing down too much in China. Now, keep in mind, China gets most of their money from exports, so when people aren't buying goods from China, that means globally the market is starting to, you know, kind of take a rest or pull back even more. So inflation over in China is still very low as well. So they're dealing with very slow or very low inflation. And their consumer prices only increased, I think, 1.6% from a year earlier. And this pace is the lowest that it's been since 2010 as well. So China, things are slowing down dramatically. And then further south east over in Japan, Shinzo Abe's got his own demons he's got to fix. He's called an early election to renew his mandate for all the economic stimulus that they put out there. And the Bank of Japan about 2 weeks ago, week and a half or 2 weeks ago, came out and announced a lot of stimulus. So the yen on that note completely fell off the table. We'll look at the yen in a minute because we had some fun with that one from a currency perspective. So the yen fell off the table. So over in the Asia Pacific area, a lot of stimulus coming from Japan, a very surprise interest rate move in China. All of this has gone to, you know, really add to the global growth. Now, if we come over to the European sector, all across Europe, interest rates are extremely low. And as I've told our members, it's caused a lot of money to move over into the U.S. markets, primarily bonds, but into fixed or into high cap, large cap, dividend paying stocks. So we're seeing that. But if China's announcement wasn't enough on Friday, Mario Draghi said, he came out and said, we're going to do whatever we have to do to raise inflation. Because inflation in Europe is also a problem. It's been a problem in Japan for 2 decades. It's starting to become a problem in China. It has been a problem in Europe for quite some time, since the debacle in 2008, 2009. So the ECB, basically via Draghi, came out and said they want to increase the size of their balance sheet to where it was back in 2011, 2012, which is when they were, you know, backstopping all the bonds from the southern European countries that make up the 18 countries that make up the euro. So they want to increase their balance sheet. And the interest rates are, as you know, are already at a record low, and it's just, it's crazy. It's crazy what's going on over there. So you've got Draghi. He's come on and he said, let's add more stimulus. Let's buy more. Now, to me, it's amazing. The GDP estimates have continually been reduced across the ECB. The unemployment, as you can see on the screen here, is over double digits. A lot of people believe 11.9 is probably understating it. So the ECB is one thing. Keep in mind, on December the 4th, which is a couple of weeks from now, the ECB is going to be delivering. They've got a meeting, and at that meeting, it is widely expected, based on Draghi's comments on Friday, that he's going to back that up with an announcement of more stimulus, buying bonds, increasing the size of the balance sheet. He does that, you're going to see another pop in the markets. If he does not do that, then you're going to see that the markets are going to react very negatively to it. Okay, so understand that is what's going on right now in the European sector here. So I find that very interesting personally on how this thing is going to be going here. So that's over in Europe. Now, if we come over and look at the U.S., well, the U.S. stocks on Friday reacted very favorably to the news coming out of China, the news coming out of Europe when the ECB with Draghi. More stimulus just means a lot of fun. So that's what these guys like. That's what the market's like, a lot of stimulus. Now, we've also seen on Friday that it just kind of goosed the markets to their fifth straight weekly advance, right? And the Fed came out and also said that they're going to reiterate it. They're keeping the rates low for a considerable time. Now, they use the words considerable time, so figure out what that means, right? But just like Japan, China, and Europe, the biggest economies outside of the U.S. are increasing or looking at dramatically increasing their stimulus, the U.S. ended its stimulus. So I find that very fascinating that the U.S. is ending their stimulus while all the others are increasing it. But inflation in the U.S. is also a big problem. Big problem. And the Feds are in no rush to raise interest rates as long as to raise interest rates as long as inflation is staying where it is right now. So inflation is I just don't see the Feds turning around anytime soon. I think the markets at the FOMC statement a week ago on Wednesday, I think that most of the market was looking for a more hawkish tone from the Feds, but they didn't give it to them. And then on top of that, you throw in for all of you statistics guys and women out there, you throw in there the Stock Traders Almanac. You know, if you go back and look at time, you'll see that October is traditionally a rocky month. And this goes back to 1950. So you're looking at what, almost 65, 70 years of time. October is typically a rocky month, and then we have a strong November and December. So generally in November, the markets are on average, going back about 65 years, are up about 3%. In December, the markets are up on average 4%. So, and just for you stat guys out there, the market in November is up 2%. So that would suggest, just from a purely statistical perspective, coming in line with expectations, another 1% move up, okay, for those of you that follow that. So that's a little bit about what's going on in the markets right now. We're finishing up earnings. You can see that the S&P is trading at fair value, roughly, or from an earnings perspective. And I had up here that, you know, we hadn't declined 10%. We didn't have a 10% correction for quite some time, and then we finally got it in October. But it was a very unusual move. We'll go take a look at the charts in 1 minute and just kind of review that piece. Now, another thing I like to do here, which I think is very important, is I want to talk about, besides the government reports coming up, for those of you that are non-U.S. or that are U.S. based, it's going to be a big holiday week. They have, or the United States has Thanksgiving. So Thursday the markets are going to be closed. Friday the markets will be open, but only for a half a day. And just knowing how most traders are going to be, most big money is going to be, they're probably about Wednesday afternoon are going to cut out, and that's going to be it. And then there'll be a small token of trading on Friday. Now, typically on these kind of weeks, you're going to see volume fall dramatically, which means the market can have a tendency to bounce around a little bit if you've got some big orders coming in and big orders going out. Most folks, most big money does not like to put in big orders this week because it tends to move the market. So if they're looking to come in and buy, 5-6 million shares of IBM, for an example, and they want to add to their allocation, a lot of them don't like to do it on very light volume days because they end up paying more money because it just drives the price of IBM up a pretty good bit, so that their average cost basis when they're done with that 5 million share purchase is higher than it would be on a high volume day. So it tends to, we don't tend to see big orders coming in this week, but there may be surprises. There may be sovereign wealth funds. There may be funds from Japan and Europe. Still, as I said, money flowing into the U.S. because it's the only pig with lipstick on right now in the poke. So that's kind of where we're sitting right now. from a money perspective. Looking at this week, we got a big number coming out Tuesday morning. It's the GDP annualized number for Q3. So we're going to get that Tuesday morning at 8:30 New York City time. Consumer confidence at 10 a.m. It's expected to be up. We've got on Wednesday, we got GDP coming out of Great Britain, a big number coming out there at 4:30 in the morning New York City time. Durable goods coming out Wednesday, and then Thursday we've got unemployment numbers coming out, and then the CPI numbers coming out on Friday. So the big number for this week, the big number that can move it, is the U.S. GDP number coming out Tuesday. And so for those of you that are following along with me in my E-mini option future strangle, I'm planning on shutting it down end of day on Monday. I will not hold it going into that GDP number. If we throw in lighter than normal volume and that number surprises the markets, well, you saw what a surprise statement just from Draghi did to the markets in China. Well, imagine a crazy GDP number. You'll get a 20 or 30 point move very quickly. Now, it may retrace 50% of that move, but holding on to shorts when it does something like that is just not a wise course of action. So what I'm going to do, and for those following along with me, for those of you members out there following along with me, I'm just going to shut mine down Monday, end of day. We should be in profits by that time, and we'll shut it down. Okay, so that's happening there. Now, one other thing I wanted to show you guys, which I think is, we do this for all of our Sunday evening secret trader sessions. It's a stock rotation guide. And what this does, and I'll just kind of explain it to you here real quick. This sector rotation, it shows you the chart, because I know we got a lot of members on here or folks attending the session for the first time. So I just want to make sure that I can kind of get this all set up here for you guys. I'm just turning my drawing tool on right now. Basically, this chart, this particular chart goes back 90 days. And you'll see here that there's 4 boxes on this chart here. And I can't count here. 3 and then 4 right here. This measures sector rotation, and the comparable is the SPX, as you see here. So this is a relative performance rotation chart. Relative performance meaning how did each of these indices or S&P sectors perform in relation to the SPX. Now remember, one of the things we like to do is find those sectors that money seems to be flowing into, and then within those sectors find some of the stock or where some of the money is flowing within those sectors. And money is constantly flowing around various sectors based on perception, consumer sentiment, government numbers, and so forth. You can see right here, this is a 90-day chart. This is based on a weekly, so each of these little circles on the tail here represents 1 week in time. And you can see down in this sector down here, the sector or quadrant 4, the 4th quadrant, is the most underperforming quadrant. And it's no surprise that energy, XLE, is just underperforming everybody else. Okay, I mean, just dramatically underperforming everybody else. In relation to where we are, you see utilities up here outperforming everybody. Now, this is on a weekly basis, so each line represents, as I said, 1 week in time, compared to the SPX. Utilities is leading the way with consumer staples. Traditionally, utilities and consumer staples is a risk-off type of investment. When money does not want to seek risk in the markets, where does it go? It goes into utilities. It goes into staples. It goes into bonds. It goes into other treasuries. But in this case, over the past 3 months, we've had utilities and staples. You can see healthcare kind of falling down a little bit and technology coming down a little bit. So it's been in this leading sector, but it looks like some of them may be rotating out just a little bit, at least on a longer term basis. Transportation, IYT, is in this sector primarily because this guy right here has got cheap gasoline. So we're seeing the transportation sector really just staying strong. So I was showing some of our members here, some of the plays, and my primary play in the transportation sector was UPS, and that's made a great move over the past 6 weeks here. But you can see UPS. Now, the others that are not performing over a longer period, materials, consumer discretionary, but here is industrials, which seems to be slowly picking back up. So let's zoom in and look at this same rotation chart of the major sectors, but let's look at it for the past 2 weeks. There's going to be a completely different view of where money has just kind of been flowing, for the past 2 weeks on this thing. So let's just come in here. Let me just put my, turn my pen off, and then let's go look at this over the past 2 weeks. Now we can see over the past 2 weeks, these same sectors, you can see it's a little bit of a different story. Where has money been flowing since the markets have been just moving on fire here recently? You can see that in this area here, discretionary doing very good. Materials coming on very strong. Remember, on the 90-day, materials was just coming up into the improving sector. But it seems like, and each one of these lines now represents 1 day in time. So it's about 2 weeks, 12 trading days roughly. But you can see materials has really come on, strongly improving. Technology is kind of holding in a little bit. But you can also see consumer staples. Money's been flowing into consumer staples. All of these guys down here, transportation, industrials, healthcare, money's been coming out of those and coming into these sectors right here. Financials have not been performing very well for the past few weeks. Utilities down here, definitely lagging everybody else. Utilities is traditionally a risk-off environment. A risk-off environment. So when money wants to seek risk, it comes out of utilities and typically finds itself in some of these other sectors. And then, of course, energy. I believe OPEC is meeting on November the 27th. All right, that's a holiday in the United States markets, but OPEC's going to be meeting on that date. And when they meet, if 50% of the analysts believe that Saudi Arabia is going to cut production to drive up energy costs, the other 50% believe they won't. Who knows what they're going to do? But let's watch this because I think it can be a tradable event post-OPEC meeting. Right now, the market seems to think that they're going to support a floor in oil around $75 a barrel. Now, we've traded oil, and we're going to take a look at the oil chart in a minute. We'll take a look at that and see. So we'll play with that and see how that looks, see if there's anything out there for everybody. So let's go in and let's go on and let's see how some of the others. What I'd like to do now is just break down some of these sectors and just look at them individually if we could. So let's look at materials. Here's the materials sector over the past 2 weeks. As you can see, in the materials sector, CF Industries, all those in green are the ones that are leading. In other words, money is flowing in there greater than, they're moving up greater than the SPX is moving up. So CF Industries, International Paper, Dow, DuPont, these guys are doing fairly well in materials. Now, materials has been lagging dramatically. Traditionally, as money rotates from one sector to another or from one security or asset to another, money traditionally tries to find those assets that are underperforming where they've fallen enough where the value, the PE ratio, the earnings per share, the forward guidance, the risk. Well, let's stop that here. Hang on 1 minute. Let me come back in here again. Where the risk is where the risk is lower. So they'll come in and they'll be able to invest in these things, and they're going for the push up. And a lot of money tends to follow that route. Okay, so this is the material sector. If we look at discretionary, this is strong, folks. Remember I showed you discretionary on a weekly basis. I mean on the weekly chart, or going out on the 90-day chart, was looking very strong. I mean, just very, very strong. So you can see here in discretionary over the past 2 weeks, Amazon. The one I want you to pay attention to is Target. Target is doing very well. Tiffany's, Expedia, Hog. Hog is the motorcycle, Harley Davidson. When you see discretionary, when you see money going out there, we're coming into the holiday buying season, Christmas buying season for retailers, which tends to be the largest. Most retailers get about 60% of their annual sales. You'll see these things kind of rotate like this. And then as we go into January, you'll see some of the money flow out of some of these discretionary retailers and move into other areas. But you can see here just how strong this chart is here. If we look at the next one, consumer staples. Now remember I showed you staples and discretionary tend to move contra to each other. When money goes out of staples, it goes into discretionary. When it goes into staples, it tends to go out of discretionary. You can see here on the discretionary, we've got Whole Foods on the far right, WFM, which has kind of fallen dramatically in this staples here. It's come down a pretty good bit, but that was a darling for the past month or so, Whole Foods. But now money's kind of slowly rotating out, which tells me it's profit taking. The other one, Archer Daniels, ADM, same thing there. Monster Beverage, MNST, you'll see that. And Walmart, of course, has come on very strong. I mean, they've just really shot through the roof there, Walmart. And Walgreens, which is one we've played in the past. We may take it again. But you can see consumer staples, all those in the green are basically outperforming the SPX. You can see those getting ready to move into the green. Typically, the rotation here, and what we like to do, just from a guidance perspective, guys, is when we find these stocks, the ones in this sector right here generally move over here like this. You can see how these move by looking at the tail, right? You can see they tend to move in a clockwise rotation like this, as money is constantly being rotated. So we can see Coca-Cola here, we can see Pepsi here, we can see Kraft here. All of these, should the market pull back, should we experience a pullback and it surprises folks, then those that look pretty good would be Coca-Cola and Pepsi, and then maybe Kraft, which is sitting down in this area right here, which would suggest that the SPX would pull back. Those guys may outperform. Okay, so that's just something we want to look at, assuming we get this pullback here. We'll look at the charts in a minute. So let's go to the next sector, technology. Remember I showed you technology's up in the leading sector, but not all technology stocks are there. Okay, you can see Yahoo in the green, which was leading. It just keeps going up and up. But now I think Yahoo, because it's had such a long run up, is subject to some profit taking and some pullback. Cisco, Apple, eBay, Hewlett-Packard, EMC, all of these are in the green. And I suspect some of these may rotate out or cycle out. You can see those others. Now, one of the ones that I'm going to probably cycle out of, as you can see, Visa, MasterCard, Micron, Broadcom, CRM. I was holding Visa through that big run up. It's like a 40 or a 50 point move up. I'm going to be cycling out of Visa, taking some profits in that, but it looks like there's profit taking in those. And notice that Visa and MasterCard are considered technology. Don't ask me why. Some people classify them in financial, but they're really a technology firm, or at least that's how they're classified. And you can see Google just kind of almost performing right in the center of the crosshairs, but right on that crosshairs, which means it's almost performing in line, slightly less than the SPX. All right, so that's how that would be read. If we look at transportation, transportation's really interesting. Matson MATX is leading the way, but I wouldn't chase that. It's probably going to be profit taking in there. The others that are leading the way in transportation, not surprisingly, are railroads, Conway, Norfolk Southern, CNW or NSC, railroad companies that are leading the way. The others are rolling out. You'll see down there, you'll see UPS that's kind of moved out. I was in UPS. It was leading the way. We've made good profits, so I'll probably cycle out of the transportation. You know, if oil starts to move up, you're going to see some of the transportation stocks take a little bit of a hit. So maybe one thought on trading is the IYT, the transportation sector ETF, maybe putting some bear calls on that one. So we'll look at the chart there in that one in a minute too. So that's the transportation sector. Industrials. Well, but the only thing in the green in the industrials is Boeing and GE. You can see Caterpillar, CSX, FedEx, Honeywell, UNP, 3M, UPS. These guys are kind of underperforming the SPX lately. I'm going to cycle out of some of the industrials. BA, you know, I've talked about that a couple of weeks ago. I brought it up several times, I think 3 weeks ago and then 1 week ago or 2 weeks ago, that BA is a little bit of a sleeper. I think that one could look pretty good as well. Energy, this is the one that I want to watch really closely. I think there's going to be some really good moves here. Why? Because energy's been decimated this year. I mean, totally decimated. And energy is going to cycle. When energy starts to get stronger, you're going to see the dollar, and a lot of this is tied in with the dollar, because as the dollar gets stronger, commodities, especially oil, has downward pressure on it because it's traded in U.S. dollars. They have to buy U.S. dollars to buy oil, even Brent or WTI. But you can see an energy right here, Devon Energy, DBN, and EOG Resources, which the ticker EOG, they're doing good. But the ones that I like Phillips 66, PSX. You can't see it, but it's in the blue there on the improving sector. I like ConocoPhillips, COP. You can see that just starting to, looks like it's getting ready to move into a leading sector. So ConocoPhillips. I've always liked Oxy, Occidental Petroleum, OXY. So those are the ones that I like. I would stay away from some of these down in the bottom down here, Rig, Valero, Exxon, Schlumberger. They're just underperforming right now, more so. Halliburton announced a takeover, but Halliburton turned into the red. So I think those stocks, when energy does finally get a boost and start to move up, I think you'll see Conoco. I think you'll see Hess, HES. I think you'll see Phillips 66, which is PSX. I think you'll see those guys move nicely. Financials over the past 2 weeks or past 12 trading days hadn't really performed that well. In fact, it was performing well, and you can see all of those that are in the yellow tail, they were all leading. Money was in financials up until about 2 weeks ago, and then money just en masse came out of financials, mostly profit taking. Why? Financials are very sensitive to interest rate rise. When the financials, banking sector, look at a possible interest rate increase, that's how banks make their profits, right? In the net interest margin of what they charge versus what they got to pay to store money. So when the Feds came out, they weren't as hawkish as people thought in the FOMC meeting minutes. It tended to put a damper on not only the U.S. dollar but on financials. So you see here that Wells Fargo, Zion, remember Zion was a favorite of ours for quite some time. ICE, Metropolitan, KeyBank, all of these are in the red. Now, that's not to say that some of these aren't better longer-term investments. I'm just talking about assuming that inflation stays very low. These are going to possibly underperform the SPX, at least in the near term. Okay, healthcare. Healthcare is also kind of taking it on the shin. As you can see here, most of them have underperformed the SPX. About the only one that's outperformed the SPX would be Merck, Pfizer, and ABBV. One I do like in healthcare is Eli Lilly, LLY. You can see it's the only blue one on the screen. I do like Merck. I do like ABBV. But again, profit taking here. Some of the favorites, Gilead, we played that a number of times. We played Biogen, which is another biotech stock. We've done those. UNH is a nice one that we've played with. Celgene. We played all of these. Money is coming out of these. So just as a sector, money is kind of flowing out of the healthcare area. Utilities. Folks, this is about as strong of a sector as I've seen. It looks like every one of them are outperforming the SPX. Now, and you know the SPX has been up strong over the past 2 weeks, but the utilities is just outperforming big time. That tells me that money, some of this money that's, made profits, you're going to try and protect profits. Put yourself in the shoes of a large hedge fund or a large money manager fund. And you've got some nice profits going into Q4, and you want to hold on to them going into the last half of November into December. So you've got to stay active in the market. So what do? You take some of the profits off the table from some of the sectors that have done well, technology and consumer staples or discretionary, and move them into utilities. Traditionally, utilities is a great sector to be in when interest rates are low. Utilities tends to move the same way that bonds move. When bonds move up, utilities move up, which means interest rates move down. And as long as there's not a fear of an interest rate rise over the next 90 to 120 days or 3 to 6 months, you get this kind of pattern here like this. So again, in utilities, PG&E, Nextra Energy, NEE, Duke Energy, DUK, some of the more popular ones, American Electric Power, AEP, PEG, Public Services Group, EXC, Echelon Corp, or XEL, which is Excel Energy. All the majors are just knocking the ball out of the park on the utility side. So if the market starts to pull back a little bit, you can probably feel comfortable in adding maybe some utilities to your portfolio because, as I've told folks, right now I'm about 40% long. And the rest of my portfolio is playing neutral strategies, delta neutral strategies with options, because we've just kind of been hung up a little bit. We seem to be grinding higher with once every 6 or 7 days we'll have a spike up or a spike down, but it's been basically a grind mode. So we're going to just take a look at charts here. So let's do this. Let's take a look at the charts. So let me just freeze my screen here 1 minute. And, you know what, I'm going to show one thing here. You guys asked a lot of questions before, and I just thought I'd put this back up here again for you. When you trade SPX versus the SPX PM, or the XSP versus the SPY, you can see up here the SPX options, right, and the value, the notional value. I'm not going to spend a lot of time on the chart because I want to get into the markets, but this session will be recorded, so you can come in here and look at this to your heart's content. But you can see the SPX options. It's cash settled, and there's no early assignment, which is why they're popular, right? The PM options settle in the evening. They settle Friday at the end of the day like all other options. But the SPX options settle Friday morning when the market's open, generally about 9:30 in the morning, 10 o'clock in the morning, they'll settle. Now, if any of you let some of your credit spreads expire out of the money with SPX on Friday morning, you'll notice that they're going to hold that margin a little bit longer than you would probably like, even if they expired out of the money. Sometimes you got to give your broker a call and say, hey, just please release the margins, because some brokers will screw with you and not release your margins, even though the SPX options expired out of the money. They've already settled Friday morning. They won't release the margins till Monday. Those crooks. So call them up on the phone, make them release make them release that. So that's kind of where that is. Can you put these charts in yeah, in fact, I'll do some of that, Randy, for our members there. I'll put some of these little charts here because there's a really good tool for you guys to look at. SPX PM settled. They settle at the end of the day. Not a lot of volume in those things, guys, so be careful. SPX minis, again, not a lot of volume in those options there, and then you got the SPY options down below. So I want to go over and look at the let's go look at the chart. So bear with me 1 minute, folks. I'm going to freeze my screen as I just move up here. And there I went again. I said, bear with me, folks. So I'm going to have people sending me emails again, but I don't care. All right, hang on 1 second, guys. See, I'm changing it to hang on now instead of bear with me. All right, let's see here. Just moving a few things around as we go through this. Let me shut this application down. All right, I'm going to get the screen up here for you guys. And then we are going to go into the charts here. Let's get the screen up. And as I said, if you have anything you want me to look at, just put it on the chat room, and then we'll go into it here. Okay. And I see, you know, a few that are already out there, so we'll go take a look at those. Like that. Okay, you should see the E-minis up here right now. You should see the E-mini S&P 500 futures, and I've got it on a daily chart. So let's back out just a little bit here, and let's go to the SPX. I've got the SPX up here. Now I want to show you guys something here. I'm going to go to a weekly chart. And you guys know that this is, you know, in all of my trading, I've been trading for 25 plus years, a long time. And you can see on here, this is a weekly chart. One of the higher probability trades you're going to take, one of the highest probability trades you're going to take is what we call affectionately in our chat room, a BED, B-E-D, bearish divergence. We got a chat room that runs every day, and you know, if we see a security that's got a BED in it, we jump on it. All right, let me show you guys something here. This is a weekly chart of the cash index, SPX, and it goes all the way back to 2011, okay? 2011. Let me turn my drawing tool on here just 1 second so I can highlight a couple of things I wanted to show here. Let's change the color on my pen. Okay, here we go. All right. So as I said, this starts back here on 2011. You can see this upsloping trend line has been honored. It has not faltered until we went into October, and on a weekly basis, we actually closed once outside of this channel. But outside of that, it has not faltered. We have been honoring this very closely. But look on here. You can see as we've made new highs going up on this weekly chart, and I'm just circling the new highs. All I'm doing is tracing the upper boundary of this channel. You can see here with the MACD, it is basically kind of doing one of these numbers there. That, folks, is called a BED, bearish divergence. And it signifies that as we make this run up, it's done so on fewer stocks or weaker volume, or weaker strength, rather. It's very subtle, but you can see it nonetheless. And if we come in, and what we want to do is now break it down, we want to go into a daily chart here. So let's take a look at this on a daily chart and just kind of see if we're looking at any divergences on a daily chart here. And you will see here when I get the daily chart up, right here, that there are no divergences at all, okay? Absolutely none. In fact, you could say that this recent move and this V bottom here, this is a lot of strength going behind this move, a ton of strength going behind this move. You can see here from this prior pivot high, This V bottom, we only stayed down here for 1 day, and then we came back up. This blue line right here, blue dash line, was the opening price of the SPX in 2014. So we actually went down just 1 day, and then we came back up, and then we went down the next day, but we never really closed down below the opening price on the SPX. But you can see this V move right here. Now, this move was about a 10% down drawdown from this prior peak right here. V bottoms are fairly rare. When you have a 10% pullback, they're even more rare. Typically, you'll find a bottom where it does one of these, it'll come up and then it'll come back down, possibly retrace some of the move, do a bit of one of these things, and then finally start working its way higher. This was just like jumping off of a roof, landing on a trampoline, and the rate of ascent up to this area here was actually greater than the rate of descent over here, even from a timing perspective. Really amazing. Very rare, folks. Buyers stepped in earnest right here. Tremendous buying pressure came on the markets. And that is why a lot of money right now is a little bit nervous, because as most of you that have been trading for a while fully understand and can appreciate, when you've got this kind of move, strong move up, everybody's expecting a little bit of a pullback, a little bit of a rest. You can see we're approaching the upper boundary of this channel. The upper channel boundary is right around 2077. You can see I also put in here, let's just blow it up so those of you with bad eyesight, including me, let me just blow it up a little bit more. I calculated off a prior pivot low, a Fibonacci extension, prior pivot high and prior pivot low. So on a daily chart, if we look at the SPX, for those of you that have credit spreads on or are playing credit spreads, what we would look at here is a couple of resistance points. We've got a 23.6% resistance point. If you can't see it, it's 2066. Again, it was calculated off the prior pivot high and the prior pivot low, you know, when the markets did that move right like that, right? And we got another one up here at 2095. Now, where are we going to end up for the end of the year? I believe, at least right now, that short of this fast run-up we had on Friday, I believe we're going to have a pullback into this zone right here, come back and test this prior pivot high, which would put us right at that area right there. You know, right around 2020, roughly. I think it'll surprise people. I may be wrong. We're going to watch the daily charts and the price action, because the only way you can trade this is just look at the daily price action. But even having said that, our R1 level, our first level of resistance, is going to be 2066. Our R2 level, because we're in dry powder now, we're up at areas where we've never been before on the SPX, is 2095. Okay, so these are the levels that we're going to watch. For those of you looking at doing credit spreads, I've got some credit spreads that expire next week, well north of 2100. I don't believe we'll make it because it's a very light week, but I'm using SPX credit spreads up in that area there. But you definitely want to be north of 2095 on any credit spread if they're expiring next week. So this is looking at this very detailed. Keep in mind, since 2011, we have not broken the upper boundary of this channel and really stayed there more than a day or two. Since 2011, we're right at that boundary level, the high on Friday, that boundary level. Now, let's zoom in a little bit more, because I know a lot of you folks, especially a lot of our members, are credit spread guys, and I like to add them to my arsenal as well. So let's just zoom in a little bit. And everybody knows in our group, a great time frame pair to use with a daily is a 2-hour. It is the best to use. Why? A typical trend will run anywhere from 7 to about 24 bars, a typical trend, before you have a change in the indicators. And our members know what I'm talking about with a change in the indicators that we follow. But So if you do the math on a 120 bar chart, do the math, and you do 7 to 20 some odd bars, you're out of a week roughly. So let's look at this 2-hour chart right here. And if we look at this, and I blow this up on this 2-hour chart, you can see our Fibonacci holding up here. You can see how close we are to the upper boundaries here of this channel right here. The high for Friday, before we had that pullback, the high that was capped on the SPX was 2071.46, and then we pulled back. Okay, that was the high made. So wouldn't surprise me to see another test of that high, maybe even testing the channel, and then a little bit of weakness. We've got an Elliott wave 3-leg up on both the 2-hour and the daily, which would suggest a little bit of a pullback. On the 2-hour, it's suggesting a pullback all the way back down to around the 2090 area. Same thing with the daily. Okay, so that's why I would suggest that that could be a possibility. If we look at the MACD on here, you can see how in this particular case here, it's kind of dovetailed off. It's not what I would consider to be an ideal bearish divergence on the MACD. But you could say, yes, it is a bearish divergence. We got highs, highs, and highs, and we just got this very, this channel within a channel, so to speak, right here, like that. I don't have it drawn on my chart, but for those of you short-term traders, you should probably put it in. I do believe we're probably going to test this area, like I said, the 2071. We'll probably come down. If we don't test it, we're definitely going to test both sides of this little short-term channel within an a long-term channel that's going back to 2011. But you can see the MACD here. We've got a high, a lower high, and now we're down in this area here. Again, a little bit of a rollover there. So that tells me that a little bit of a pullback into this area is probable. Doesn't mean it's going to happen, but that's where the odds favor right now. Okay, and this is, we don't need to look at the E-minis, but it's the exact same chart, only just a couple of points off because it's the futures market. Okay, so that is how we're looking here. Now, one other thing I will point out, I will go back to the daily chart, and I want to show you guys something here. Let's come back to the daily. If we look at the daily, you can see right here, we've made new highs, right? Friday closing, we made intraday highs at 2071 on the SPX. No bearish divergence on the daily, so any pullback is going to be a minor pullback, possibly to the prior pivot high, which is around 2020, as I said. But now let's look at the Russell. If we look at the Russell, guys, weak. It has moved up some. And you can see, though, the high with the rut is at 2013.44. You can see that blue line is where the rut opened. The Russell futures opened in 2014. And you can see we're nowhere near the highs. So the Russell has been underperforming, but I think all of you guys know that, right? I mean, the small cap's been underperforming this year. And I have said that the small cap's either going to have to catch up or the rest of the market's going to pull back like the small cap. At some point, one of these rubber bands is going to pop. If I blow this up, let's zoom in a little bit on the Russell. The Russell traditionally leads the market higher and lower. You can see right here on this rut, we actually pulled down. We closed almost right at maybe just a fraction of a point or so above the opening price of the rut in 2014. Right? You can see this blue dashed line there, and you can see where we closed. We had intraday lows down to 1148, but we actually closed right around 1157, 1158 on these two bars. And then we moved up, and just our intraday high was a prior natural pivot high at 1187.90. 90. You can see that right there. So I want to see us, for me to get a little bit more confidence, a little bit stronger market coming back from the holidays in the U.S. going into December, we got to take this guy out here, 1187. So what we're going to say is this number right here is going to be our R1. That's going to be our first level of resistance going up. Of course, our first level of resistance coming down is going to be that area right there, 1148.20. Very wide, right? I mean, very wide. These are the main areas that we're going to see. Are we going to have a down December or an up December? Okay. Obviously, for next week, the key for me is going to be the opening price for the RUT for 2014. It's right in that dashed blue line there. If we come back down and challenge that and come back down in this area here, the rest of the markets are not going to look good. And you can see, let me just clear my screen a little bit. It's starting to look like John Madden drawing a football summary play. You can see right there, there's the 200 EMA. That's the yellow line. And then here's the 50 EMA right there. And you can see they're like railroad tracks. Neither of them are moving up and neither of them are moving down. They're almost flat with each other. But the note is the 50 EMA is below the 200 EMA. We're going to need to see more upside action here to get that 50 to give us a little bit of a cross and get a little bit more support. Why is that important? Well, the big guys make it important because typically when the 50 moves below the 200, a lot of black boxes are programmed to sell. Or reduce their holdings, not close it out, but just reduce their holdings in stocks that the 50 is below the 200. And stocks that make up the small cap especially, because small cap tends to be more volatile, and as evidenced by the movement of the Russell. So this is where we're looking at the Russell. We want to see the Russell come up here like this. That's what we would like to see. If we can get this, then that's going to bode well for the December months for the rest of the markets, okay? So use the Russell as a good proxy just to kind of see what the rest of the markets are doing. That's how we want to play that out, okay? If we look at volatility, let me just come over here and pull volatility up. We'll pull up the old familiar VIX, okay? And let me just zoom out on the VIX here a little bit. And as you can see, well, that may be just a wee bit too much. You can see these shaded zones here like this. And one of the things I don't have on my chart, but I've liked trading the VIX. When we hit these peaks here, well, let's try it again, Brent. We'll come here and we'll come down like this, like that. And then let me just, oops, let me turn it off. Get that off right there so it doesn't mess up my chart too much. Okay, you can see this downsloping trend line. What we've done and the way we've traded this and the way I've kind of put it out to our members, and a lot of folks have had some fun with this, we've done very well. It just takes a little bit of tenacity to stay with the trade. Every time that we've had these peaks like this, and it's a repeat performance, right? Repeat performance. And this one was the October unusual, big spike up. It's paid for us to come in and play VXX, okay? So we typically play VXX to the downside. You know, now I got into VXX right here. It's a little bit too early. I was expecting it to roll back over like all these other times, but we had October, and then it just kept going up. So I added to my I did a position there, I added to my position there, and then I added to my position there, and then literally inside of just a few days, we were back down here again. I mean, it was really crazy. So you had to have, when you trade a volatility play like this where you pick up VXX puts, don't go all in the first spike. You know, just if your normal position size, let's say, is 10 contracts, go in with 3. And if it spikes down, just say thank you very much, take the profits. But if it spikes up, then add maybe another 3 and another 3. If your normal position size is 10. If you go all in with 10 and then you have one of these things like that, then it's gonna be very difficult for you to hold the trade on puts. And that's the smart way to do it. You want to just kind of leg into this. But when the VIX falls, it falls very hard, okay? And we got other ways of playing this also. I'm not going to go into the details on that, but they're fun volatility plays, and they should represent 10 to 15% of your portfolio, and just one of the ways that we play vol. But anyway, this is volatility. Let me just get let me get my drawing tool turned off here so I can get back to my cursor. Let's see here. Let's get this done here like that. So, okay, let's come back and let's kind of quickly go through some of these markets right here. Remember I said treasuries. It moved up. Low inflation, no incentive to raise interest rates dramatically quickly. This is an annual chart of bonds. You can see this upsloping trend line actually starts on January the 2nd, right here, surrounded by blue. It's kind of a zone. This is the bond movement for the entire year of 2014. Only once did we go below that zone for about a week, 7, 8 days, and then boom, we recovered very quickly. And now you can see bonds moving up like this. I believe, and I've been playing bonds with credit spreads rather than directionally. I believe longer term bonds will fall, not as fast as everybody thinks, because I think it's going to take the Feds a lot longer to start raising interest rates than people think. But you can see right here, looking at the current market action, I've got a little tiny upsloping trend line right there that supports the thesis that I have, that I think bonds have still got a little bit of movement to the upside. All right, so and there's a number of different ways if you don't trade bond futures. In our group we trade futures, commodities, and equities, and you can see this rounded bottom like this in the MACD. I think it's going to run up and then probably roll over again. You can see this rounded bottom right here like this. It's not going to give us a cup and saucer. I do believe it could come back up into this area here around 143, and some change. And right in that area there, if we make it up there, I hope we do, time to add some shorts. Okay. Now, there are different ways to play bonds. You can play TLT. TLT moves in the direction of bonds. So if bonds moves up a little bit more, we go short TLT. If bonds or the other way of doing it is TBT, which is just the opposite. TBT moves in the direction of the interest rate, right? So it's kind of a proxy for interest rates. It moves the opposite of bonds. So TLT moves in the direction of bonds. TBT moves in the direction of interest rates. So I think we got a little bit more movement up here to the upside. I think it's going to come back down again, test this line, and I'm not going to really get aggressive short until we can break this guy here. Call it 140 even. Then I'm going to get aggressive in taking the shorts. Next stop down is the 200 EMA. Okay. Remember, it's $1,000 a point for every 1 point move in the futures, or TLT, TBT, depending on what strike you want to select. Okay. So this is kind of a short-term view of bonds. For those of you members, when I get ready to jump in one of these things, I'll put a note out there in our chat, or I'll send you an email. I'm working on that as we speak. So that's the bond market. If we look at currencies, boy, what a day we've had, right? Currencies, we've had a lot of fun for those that like them. Let's start off with the U.S. dollar. We've been bullish, the dollar. We've taken profits 2 or 3 times. You can see this huge move in the dollar. This is the daily chart right here. And if let's zoom out just a little bit here. You can see this dramatic move that we had. Now, the one thing that tells me the dollar may get a little bit weaker short term, especially since they've said the interest rates is going to rise slower than people think. We've got this 3, 4, 5 pattern, which is a traditional Elliott Wave pattern. But the only thing that's unique on this Elliott Wave 5, we do not have bearish divergence. I would like to see bearish divergence. We don't see it. So I think any pullback is going to be similar to this pullback here. Remember, we were long the dollar here. It pulled back. We took our profits because we didn't know how far it would go. It stayed right in this natural price zone here, and then boom, off to the races again, and we got long the dollar. Then it's kind of stabilized in this tight area right here. And you could probably say, well, it's similar to a bull flag or a pennant. If I were to come in here and let me just get some of these drawings off here and get my drawing tool back on here so that you guys can see it a little bit better. You can see the U.S. dollar on this chart right here. We've been in this tight pattern right here, and we actually made new highs on Friday, right? We actually just poked our head up above with new highs. How high can the dollar go? Well, this is a 5-leg up. I think there will be a little bit of near-term weakness, but how high can it go? Well, let's go to the weekly. I'll show you. The dollar can go a lot higher net. Look at these weekly bars on the dollar. I mean, that just 1 week last week when we had a little bit of a pullback, we got out, took some profits, but we had a strong week last week. If we zoom out on this for the U.S. dollar, you can see here, let's just zoom out even more. I'm going to really go back here just to show you. I mean, look at this. That shows you that the dollar can go a lot higher, right? If I were to just kind of cap this right there, there's a spot right there. There's a spot right there. These are the next ones coming up. And you can see when the euro came into existence, I was over in Europe at the time, you can see the dollar was up here at the peak, right up here back in 2001. Okay, but you can see where we're sitting right now. The dollar's breaking out of all these key areas, and if the Fed start raising the interest rates and the interest rates stay lower in other countries, more money is going to pour into here, you can bet. And it's going to pour into the U.S. dollar, you can bet. So again, looking at this weekly chart here, the dollar is going to come on strong. Now that's going to have a tendency to keep a ceiling on commodity prices, because a lot of commodity prices are traded in dollars. But you can see these zones here as we go up higher and higher. So again, this is a weekly chart. You can see the trajectory of this weekly chart. This move started in the summer, June 30, and you can see, boom, that is a huge move, folks, in the U.S. dollar. That's another reason why oil has been pummeled, why a lot of commodities have been pummeled. And never mind, forget about, look at gold. We'll take a look at the metals charts in a minute, but this is the U.S. dollar. Can it go higher? Yes. If we come into the weekly, I think we're going to kind of have a pause for the cause, and then I think it's going to roll higher. But this is kind of where we're sitting right now. This is the weekly for the dollar. Another one that we played bullish, I actually thought when we were bullish, this one, and I played it bullish, I thought we would be, the British would raise interest rates before the U.S. And when did we play it bullish? Well, to the left of this chart. You can see right here, the pound has been pounded. You can see we played the bullish action on the left side of this chart, and then right around the peak we got out, and right in this area here was when the Scottish came up for a vote. Do they want to stay in Britain or not? You can see this dramatic channel coming down here right now, and you can see how we're bouncing off of this low right here on this daily chart. Now, Britain just came out and said inflation sucks there too. And so there's really no need for them to raise the interest rates. You can see here on this chart, we got a little bit of a bullish divergence, not much. It's kind of countermanded by this little interim bump right here. So I think the pound possibly can go lower. I did just take a very small trade in the pound to the upside right here. I'm just slightly in profit, but I think the pound is probably going to go lower before it finally reverses and starts moving back up. You can trade the British pound, you can trade Forex, or you can trade FXB, Foxtrot X-Ray Bravo, for the pound. If we look at the euro, well, the euro is just not pretty, folks. The euro is just one of those securities that I said personally that the risk of the bigger move is to the downside. You can see that big move on Friday when Draghi came out and made his comment right there. We had the traditional 3-4-5 pattern. We had the bullish divergence. We slowly started moving up in this channel. And then that announcement came out, and then it was just ugly from that point on. I mean, it was very ugly. You could see the bullish divergence there. So we had a bud on. And I supported in this area right here, just doing some short-term trades to the upside, but you could say this is a bear flag, and then boom, we broke out. So guess what, folks? That's probably where the euro is going to head, probably down. Now, this zone is a very wide zone, but it's a natural price zone. So I think the euro is going to find itself down in this area down here. Remember what I said, the ECB is meeting on December the 4th. And if they come out and they say, yeah, we're doing more stimulus, guess what? That sucker is going to keep going down. You're going to see sellers continuing to drive the euro down. And what is that going to do to the dollar? It's going to drive the dollar up, okay? And then that's going to drive oil down, and it's probably going to drive gold down as well, all right? So this is kind of where we're sitting right now with some of these market relationships. So, and some of these are abnormal relationships. We don't normally have these like this all the time, but because we've got so much money in this giant soup bowl, trying to find a place to go for a yield, that's kind of where we're sitting now. Now, the other one that we played to the downside, which I really enjoyed, is the yen. We've made some great money on the yen over the past few years. This is a daily chart. You can see right here for our members, I was telling our members, you can see that shaded zone right here. I said, folks, and we were talking about this every week for almost 6 months. Every time it broke to the downside, we would take a short position. Sometimes we'd get stopped out. Sometimes it was very quick. It would go back up for small profits. But I said eventually it's going to break and it's going to come down and challenge this pivot low of 0.9486. That's what it did. And then we immediately broke that down. We came up and did a challenge. So for a lot of our members that missed this trade, I said we're selling on rallies. So we had a perfect entry right there, and boom, here we are right there. So, and I know we got some members that have traded this all the way through, and you're up over $20,000 per contract on the Japanese yen, which is really great. Or you can trade Foxtrot X-Ray Yankee for the yen. So really nice trade on the yen. All right, so that's just kind of a quick overview. We have not traded the Aussie in quite some time. You can see the Aussie did the exact same thing. I had talked about this range-bound trade, and when we break out of the range, look at that. I mean, it's just beautiful setup. Boom, off we go. Again, a big move to the downside. We've got a lot of bullish divergence on the Aussie right here. You can see this. And we've got a floor right here on the Aussie that was set back a few days ago, about 2 weeks ago in the Aussie. So, and we've got this bullish divergence. And unlike the yen, if once we get the signal on the Aussie, I'd be more apt to be long the Aussie and kind of a contrarian play, at least back up to this prior pivot high on this Elliott Wave 4 right there. Okay, so that's kind of wrapping up the currencies. We've got a number of sectors here that have done very well. If we look at the retail XRT, look at that, guys. It really had a big move up and then kind of sold off, but we took out prior pivot highs. I think the XRT, there is no bearish divergence right here. It's probably going to come and test this prior pivot high at 89.94, but again, looking good. If we look at the biotech sector, it's kind of, I'd be very careful with the biotechs right now. We're in this very tight pattern right here. Unless we can break out of it, let me just kind of color code it in right here. This right there, if we can break out of that pattern, whichever way we break would be the trade I would take on XBI. It's kind of a favored stock on the biotech. So let's watch this one and see how this thing plays itself out. Energy, remember I showed you, it's starting to come on just a little bit. You can see right in this area here, XLE is still below the opening price for 2014 of 87.98, so it's still underwater. Oh, I'm sorry, we gapped up. That's going to be the support area here. Now this typically is a 3-4-5 pattern, which would suggest more downside action. But I'm going to stay clear of energy until after the OPEC meeting. That's going to give us a clue of how we want to play that. Technology, if we can get, let's get the technology up here. Again, Same thing as retail. We made new highs, and then we just kind of closed flat here, right in that area for technology. Transportation, well, what can I say? Almost the exact same pattern. Every one of these has a very similar pattern. You can see what looks like a little bit of a bull flag there, and then we broke out to the upside, and we come right back here again on this. If we look at consumer discretionary, again, you can see the red candle on there. We opened and went way up, and then we come back down. I think we're going to test the prior pivot high. A little bit of a rest is kind of what I see there. Industrials, if we look at industrials, you know, I wouldn't call this a spinning top on a candle, but I mean, just boy, what a move up on Friday with industrials. I think the risk favors a pullback. Folks, if we get a pullback on a lot of these to the prior pivot high, we consolidate and we start to move up, that would be my signal to add more longs. Right now, I'm not going to chase these guys. I'm going to stick with some neutral trades until we kind of see how this thing plays itself out. Banking, you can see the banking sector had, like all the others, it was pulling down almost like a bull flag, and then bam, it moved up. I think banking's going to pull back as well, at least in the near term. Utilities, well, here's utilities right here. Remember, unlike the others, utilities looks like it's more of an upward trajectory to challenge this prior high here in the utilities right here. Keep in mind, if the markets do pull back, the utilities are going to be stronger, and we'll find ourselves up at 46.61 on the utilities. Healthcare, you can see the healthcare sector right here. Again, very strong. Everybody, every one of these is either reaching new highs or challenging new highs, or very near new highs. Just very, very strong. And then, of course, staples. You can see here with consumer staples, same pattern, every single one of them. And I would suggest in here that all of these are probably going to be due for a little bit of a rest coming up here shortly. Gold. Let's look at gold here for a minute. Gold was up 10.6 on Friday. If we scale out, here's the channel for gold right here. You can see how we've just been moving down. I've got my Elliott wave count on the chart here. Looking at gold, if I come back over to the MACD over here, just to get this in here, you can see we're at a 3-4-5 pattern with gold. But on this channel here, I don't see bullish divergence. So we did get a buy signal here moving up, but notice we're sitting just under the 50 EMA. I think possibly more downside action with gold, or certainly near term. Now, we traded gold before. I put it out to our members. A lot of our members traded GLD. I traded gold options, or options on gold futures with bull put spreads, just betting that it's not going to come down and take out some prior lows. I will look at that again on this quiet week right here, because the gold made this interim low of 1130 going back on November the 7th. So that's gold. Silver, this was another one that we had talked about, and I said I favored bull put spreads in silver. Silver has underperformed gold this year, but you can see here there is no bearish divergence here. In fact, it's an Elliott wave 3 down. That would suggest more downside with silver. Okay, more downside. We got a couple of overhead resistance points for silver right in that area there, right in this area here. So you can see, I think silver is nearing an area here where if it rolls back over, I'm going to look to just pick up some shorts in silver. SLV would be the proxy, the ETF proxy. It's cheap. You know, it's $16.42. So it could be an easy one to play if you just want to, if you want to buy the stock and not worry about options. If we look at energy, if we come over and just take a look at oil right now on a daily basis, here's the channel for oil. I mean, oil has been ugly. I don't know how else to say it. If I zoom in on this daily chart with oil, you can see that channel. In fact, it actually outperformed the channel and it increased in intensity to the downside. Now, I was trading bull puts right in this area here while it steadied it up, and I got out with some nice profits. I may be interested after. I think there's going to be some good trades in oil or in the energy sector or XLE after OPEC. If you hear that the Saudis are going to support oil and they're going to increase production, that's the magic signal there to come in, break your vacation time up or your holidays up, come in on Friday if you get word of that, and at least that's what I'm going to do, and start looking at longs in energy because it's been decimated. I'll probably do some bull puts in the oil futures, and I'll probably look at least, at a minimum, oil getting back up and challenging the 50 EMA. The 50 EMA for oil futures is sitting around 84 right now, and oil is sitting at 76. So, that's about an 8-point move or so. So that, to me, looks good. Natural gas, well, this sucker is like a Mexican jumping bean. It is all over the place here. I mean, and a lot of you guys that are trading it now are learning that natural gas is a very volatile security to trade. You do not want to be in it a long time. As you can see here with this chart, it came down, did a perfect 3, 4, 5, had a little bit of bearish divergence. I think near term for natural gas is down, not up. I think it'll probably test its 200 EMA, sitting right around 4.11 roughly, and then come down and test the 50 EMA. You can see the test here, the 50 EMA on that gas. UNG is the proxy for this. If it breaks the 50, we're going to come back down sub 4. All right, that would be nat gas. And then finally, gasoline. We haven't traded gasoline futures in a while, but we've had some great guerrilla trades in gasoline futures. You can see this chart. That is ugly, if not uglier than oil. I think gasoline is also going to react kindly to an increase in production, or sorry, a halt in production or a slowing down in oil production as well. You can see, though, we're on this 3-leg down. It would suggest a little bit of a move up and then people looking to short a rally. That would be a point right up in this area here, just slightly south of the 50 EMA. The proxy for gasoline futures is UGA, Uniform Golf Apple. Now, we've had some great trades in the agricultural sector too, wheat and corn. And I know we got some farmers out there, and we had some great trades in wheat and corn to the upside. I was doing bull puts on the wheat futures. If you can't trade options on futures, WEAT is the ETF proxy. Not a lot of volume in it, but you can trade the stock, or CORN for corn. I think we're nearing an interim high on these. I think it's going to pull back a little bit, but you can see both wheat and let me get to the corn futures. Here we go. Here's corn futures right here. Same thing, nice move up. We're starting to get, in fact, the 200 EMA put a pretty good halt on the corn futures, but we played it to the upside. We had this beautiful bullish divergence, the BED, and then we took the trade. I know some of our folks really just hammered in some pretty good profits on the corn futures, and it trades very liquid. For those of you just getting into futures, the ag market's a good one to start in. Meats. Live cattle, we're not ready yet for a short. We will be, folks. I'll let you guys know. We've traded in and out of live cattle, mostly to the downside. You can see live cattle is at all-time highs. I love, love, love trading commodities when they get when there's supply and demand disruptions, because when they snap back hard. This is live cattle right now. It's up. We've got a lot of snow, to say the least, coming across a lot of the Great Plains and Northern Plains in the United States. Very cold weather. It's doing a number on the herd there. So I think this could probably run up a little bit more, but we're going to be watching that for the downside move right there. We haven't done anything in the softs recently. You can see sugar. It's basically anytime we get up in this area here with sugar, we're looking to sell. It's an easy one on sugar. We've traded coffee futures, JO, the ETF for coffee, Juliet Oscar, the ETF proxy for sugar is SGG. Sierra Golf. You can see coffee right here. We're not in it. We're kind of in this no man's land. You know, pick your poison. It could go either way. So we're not playing any of these. So that's a little bit about how some of these stack up here right now. Just a couple of stocks. I think, Ian, you talked about one. We'll look at, let's see if I can get this thing up on the screen here. Lionel Bassel Industries. Okay, let's get this up on the chart here. You know, really interesting. On this guy right here, I think you're going to have more sellers coming in than buyers as this thing runs up. It really ran into resistance on the 200 EMA. I mean, that's fairly obvious just by looking at the chart. There's the pivot point right there, 96.81. You've got the lower pivot right here. Right in that area there. We've got what looks like a bearish or a 3-4-5 pattern in the Elliott waves. Most of you guys know that in Elliott wave theory, and I don't do my trades on it, but I do use it to help determine bias. You got a 3-leg, a 4-leg, and traditionally you get a 5-leg. We did not get that, so buyers are propping it up right here. If we can break out of this area and break up, I would be more prone, Ian, to go long. Otherwise, I would support more shorts back down in a test here, because it could be in one of these very long, choppy, elongated bases where we're up here, we're down here, we're up here, we're down here. So you got shorts down here, you got longs down here, and you know, you're just playing this kind of trade here. If you can get premium out of the money, bear call spreads or bull put spreads, depending on where it is, depending on where the price action is, that could be an interesting one as well. So that would be just purely looking at the chart, what I would see there on that guy right there. So let me just see here. Let me come back in here, get my drawing tool back on here, erase the drawings, and let's come back here. So that would be how I would see that one, okay? Now, a couple of other things that I wanted to show you guys here as we go into December months. You remember I talked about consumer staples and the spiders. This is the consumer staples in relation to the spiders. Okay, so it's basically XLP. It's a chart of XLP. It's a ratio chart of XLP and the spiders. You can see when it's going down like this, that means XLP is underperforming the spiders, which is a good thing, right? We want to see that. Tells me a little bit more risk is coming back into the market. That is a good thing. If we look at the other one is, let's look at the discretionary and staples compared to each other. You can see here we're just now trying to break this downsloping trend line of the ratio of discretionary to consumer staples. If we break it to the upside, again, more risk coming into the market, a good thing. But we're, folks, and this is kind of really an interesting market as we go into the end of November into December, because the markets are right at a point where, you know, just a tiny move one way or the other, and it's going to move a little bit more, which is why I'm saying I would be more apt to vote for a pullback and a rest before moving higher. That would be my vote. Now, if we get a breakout and a continued higher, well, we'll play it that way. But what I'm seeing right now is that kind of trade. If we look at the Russell compared to the spiders on a ratio chart, let me just see here. Let's see if it comes up. May take a little bit of a while here. Here is a daily chart of the Russell and the spiders. Again, the Russell is underperforming. This is not good. Look at that trend line right there. This shows you that the rut compared to the S&P 500, I think we've all known that, but lately it's still underperforming. And until we break this trend line, there's still a lot of risk off kind of environment in the market.
we need to see follow through with a small cap. So just pay attention to that, guys. That's kind of where we need to be. If we come down and just look at a couple of favorites, we come down here and let's just take a look at, let's see here. Let's look at Apple. I know it's a favorite of a lot of folks. I mean, we're no bearish divergence. This is just all bull right here. I mean, nothing but. We came up. We actually took out the prior pivot high of 117.28 and made a new pivot high on Friday, but we immediately sold off. Again, I'm expecting a little bit of a pullback here in Apple. Where could we go? Well, if we have a little bit larger pullback than anticipated, probably right down to that area there, 107, about a 10-point move. I would not be opposed. Well, let's get this off here. I would not be opposed to doing bear call spreads in Apple. Okay, I wouldn't be. And next week's going to be a quiet week, or it should be. Understand we got the GDP numbers coming out, but it should be other than that, it should be a relatively quiet week. But Apple has just been through the roof. BABA, which money has been flowing into BABA big time. You can see this big move down. I think we're going to. This is going to continue to be a very tricky trade because there's not a lot of stats on this one. And I just think the near term probably favors more a downside move than an upside. If we get a little bit more of a sell-off in December, I think you're going to see BABA fall back a little bit more. FireEye I do like as a technology stock. It's more in the security side. You can see this very long basing pattern here. If I were to draw it in, right in this area here, that's the basing pattern that we're in right now. Let's get it drawn in there. Oh shoot, let's try it again. And in this basing pattern, you'll see this a lot of time with stocks where they just base and then finally they start moving up. Okay, and it's kind of tricky trading inside this base because, you know, when it gets to the top, it sells off. When it gets to the bottom, it goes back up. So what you want to do is towards the bottom of the base, be looking at bull put spreads. Towards the top, you can go in with credit spreads, but go light because the odds favor a break to the upside, not to the downside, and FireEye. Okay, so that would be that one. Yahoo, well, what can you say about Yahoo? I mean, look at this chart, guys. I would favor bear call spreads in Yahoo at the moment. You can see here we've had this huge run up. Just crazy right in this area here. And I would favor this, and it may poke its head up above just to prove that it can, but I would favor a move to the downside on the interim basis here. And I favor this in a lot of these stocks, even though I may be bullish longer term, but interim, I would favor that. Facebook, another popular one that people follow. You can see right here, I favor more downside action on Facebook. We've had some bearish divergence of late. I think it's coming down. I think it may come down. We're sub 50 EMA. I think we're going to challenge the 200 EMA at 68.44. That would be Facebook. LinkedIn, well, LinkedIn is just kind of in no man's land. I mean, we've had, we took out the prior pivot high a few days, or, you know, just a little bit earlier, and then we've got this right here that we're testing, that gap up test right there. If this breaks, if that gap breaks, we're going to come down and we're going to probably test this area right in that area right there. Okay, so I would be short term, and you see the bearish divergence, so that would suggest short term will probably come down, test the 50 EMA in LinkedIn. If the markets all roll, that's where LinkedIn's going. One I do like, I didn't talk about, is Discover. Check this chart out. You can see the channel on Discover. Beautiful channel. I mean, well, let's blow it back up. I think I shrinked it too much here. This channel, it's honored this almost like the SPX going back to April of 2013. you can see where we are right here in this channel. It's probably going to challenge the bottom part of this channel. It's sitting right on the 200 EMA right now. We've had weakness across the board in Visa, MasterCard, and Discover. Discover's been on a better journey than most, although Visa's done very well. If we take out the 50 EMA in Visa, I would support, in Discover, DFS, I'd support more downside move to test this channel down here. Okay, if it gets down in this area here, we're going to switch and look to be buyers. All right, that's kind of how we're going to look at that one. Google, well, Google of late has been having trouble. Look at that pattern with Google. Downsloping trend line. I would favor more shorts in Google. It just could not hold an up move to say anything. Even over the strong up move that the market has had, it's just breaking down on the 200 EMA. So I would favor more shorts in Google. All right, that would be kind of to me, a lower risk move. And if the rest of the market start to falter, that would be, you'll see Google continue on down. Pulte Homes, we've liked Pulte Homes. I remember with our members, I was having you guys go long Pulte when it was $4.50 a share. And I just said, guys, at some point it's going to get $20 a share. Just go crazy on this thing. And that's what we did. So now we're sitting at $21 a share. Home builders look good. All across the board, home builders look good. Pulte looks good. Lennar, L-E-N. You can see Lennar looks good. We had this tight pattern with Lennar. But again, all of these guys, don't chase them. I'm looking for a little bit of a rest this week in some of these prices. And then, then I want to see, or is December going to be an up move or are we going to get a down move? All right, that's kind of how I want to see this here. So, all right, folks, I want to make sure that I got a lot of, because I think a lot of these stocks are already covered with some of you people here. All right, I hope you've enjoyed the session. Send me an email on other things you'd like to see covered. This will be a monthly session. It'll always happen on the Saturday after the third Friday, option expiry. And we'll cover stocks, we'll cover favorite things. Remember, for those of you that are free members, this is free, but we've got a lot of in our membership. We've got check out our site. We've got a really good session coming up on position management and trade adjustment. That's going to be starting in about 3 weeks. We've got a number of other things coming up that I think you guys are going to enjoy. You got tons of educational material, and then of course the chat room where we're posting trades and a couple of other things that are happening. All right, everybody. I hope you've had a really great day. Enjoy the Saturday remainder of the day, or for those of you in Europe or Asia, wherever you may be, enjoy the evening. Have a good one, everybody. Bye now.